Yes, I think, actually the potential rebound could last for a longer time because from the sentiment perspective, it was really weak before and the market having a lot of cash sitting on the sideline waiting for the government to have different form of, boost or catalyst. And we are seeing the government coming out with different form of catalyst. For example, potentially reducing the VAT tax, potentially reducing the personal tax, and also allowing the domestic PE funds to help restructure some of the listed companies. So the sentiment has turned very strong, last Friday and today, and we believe is going up, and then we are continue to add positions.
William, I think the key word you stressed there, William, is talking about sentiment here, because it's not just the government measures people are anticipating, and it's also the voice of confidence that the government has really lent to the market as well. But are the steps that we anticipate authorities in Beijing to take enough to impact the fundamentals here, given that there are some concerns about the overall growth slowdown, even if you count the trade tensions as well? That could make it worse.
Yes, I think the government will continue to have even more policy, if you like, to support different sections of the market. For example, the key is to provide liquidity to the SME, and that eventually will impact the employment and the domestic inflation. So we are expecting more policy coming out, and the sentiment actually is turning.
That being said, William, where do you look for opportunity? Are there any sectors you're watching specifically?
Yes, for the domestic China A share, we are looking for the oversold sectors, for example, consumer discretionary and consumer staple. Before that, a lot of money rotate out from those sectors towards infrastructure, which is because of the fiscal policy, a lot of money going in there. But for us, we are looking for mid to long-term kind of growth. Those sectors are actually continue to grow for 20 to 30% for the next few years and got sold down. We believe these are a good entry point for long-term global investor in the China-Asia market.
If we broaden the view outside of China, let's talk about some of these Southeast Asian markets too. There have been points of concerns here regarding the global trade tensions, but also specifically for some of the current account deficit countries too. What is your view regarding this area?
Yes, I think in general, we are actually thinking about global allocators should reduce the exposure in U.S. equity and in result adding more to the Asian equities in regard for the growth and valuation, because in the Asia Pacific region we are talking about more than below 1 times PEG growth, if you like. So for some of the Southeast Asia countries, we are relatively more positive on Vietnam and India. For example, Vietnam, the growth is very strong in terms of GDP growth. They are also benefiting some of the factory move from China to Vietnam. And same as India. India is a strong domestic story, got sold down dramatically year to date because of the rupee depreciation and concern on oil price. So in general, we are positive on Vietnam and India on the Southeast Asia.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.